Right.
Yeah. Hi, everyone. Good afternoon. Welcome to today's webinar. We're super thrilled to have you with us as we explore one of the most talked about offerings in the current, market landscape, the JM Large and Mid Cap Fund. Today, we have with us Mr. Mayukh Datta, who's the CBO at JM Financial Mutual Fund with over 26 years of experience across mutual funds and insurance. He's held leadership roles at ITI AMC, Mirai Asset, IDFC AMC, and Standard Chartered too. He brings deep expertise in business development, product strategy, and retail financial services. So over to you, sir. If you could give us, a little bit of an understanding of what the session is going to be, what our viewers should look forward to, it would be great. Just like a small summary.
Sure. So thank you, Neha, for having me on this show today. It's a pleasure to be here and talk about a very exciting category. So hopefully by the end of this session, we would like to give your audience a certain deep dive and understanding in the most simplest way possible to talk about what is a large and mid cap category. It doesn't sound as intuitive probably as like a flexi cap or a large cap or a mid cap. So this category, in short, tries to bring in the best of both worlds, which is the large cap category, which are the top 100 companies listed on these equity markets from an investment point of view, and mid cap being the next 150 companies. So from 101 to 250, those are the 150 companies which are considered as mid cap. So what today the audience would probably take back a lot of information about how does investing in these 100 plus 150, the top 250 companies, which are typically called as the large and mid cap space.
Okay. Thank you so much for that. I think we can start off with a little bit of a questionnaire round to keep it interesting, right? So, why combine large and mid caps into one fund, right? What are some of the key benefits of this blended approach over, pure large cap or pure mid cap strategies?
Sure. So that's actually the right question. And when we go in deep, people have the option to buy and invest into a large cap fund and a mid cap fund separately. So why take it together? That's the right question actually. And there is a rationale behind why there is such a category exists. See, there are a couple of reasons why we do that. When you get into a single cap product, which is a large cap only fund or a mid cap only fund or a small cap only fund, your investment universe is predominantly the money gets invested into that space, and that's where minimum say about 65-70% of your money will always stay invested into these categories. Sometimes what happens is maybe they go through a really great period, and sometimes they go through a very strong volatile period, which may not happen in the other two categories and so on. So therefore having a blended product sometimes helps you to override times of volatility, and that's what these type of mixed funds try to address that issue for investors. Now in the case of large and mid cap, there are some data points which you would find very interesting to understand. The top, these 250 companies put together today have 82% of the listed market capitalization on stock markets, which means the value of all the companies put together, these are the top 250 companies take away 82% of the total market cap in Indian equity markets. Not only that, within these 250 companies lies 93% of Indian corporate profits listed on stock markets. So it's a huge category, and not only that, once you look at it, what you're getting a benefit is that mid caps tend to have slightly accelerated growth rates, but they come with their own volatility, which comes with time during which we have seen in the past last 6 to 9 months now. Large caps, people tend to find them to be not as growing, but please understand that large caps also are very strong and they bring their stability and strength to your investments. To give you a simple idea, even large caps continue to do well. How? Today, the 100 company, the smallest large cap today is roughly close to about 91,000 crores in market cap. The largest company is almost close to 18 lakh crores, 17.78 exact, almost 18 lakh crores. So even large caps can grow. The smallest large cap can grow 18 times to become the mega cap. So even large caps grow. So what you are getting in this such a product is the blend of stability and agility put together into the fund of large and mid cap.
Okay. So historically, how have large and mid cap combinations performed, right, in terms of returns and volatility compared to standalone indices?
Okay. So what happens is when it comes to large caps and mid caps, yes, the data for the last 10 years show that out of the last 10, 11 years, almost 7 years, mid cap has been ahead of large caps. Now, in any investment scenario, people would definitely then find rationale saying that why should I invest in large caps if out of last 10 years, 7 years, mid caps have been ahead of large caps. So why should I put money in large caps? But what happens is there have been 2016, 17 when when mid caps have rallied much ahead of large caps. However, the next couple of years, mid cap has had huge volatility. So people come in by watching the returns of past performance, and then once the volatility happens, they tend to move out of the investments and they probably stop their SIPs. They say that this is no longer working for me. I saw very strong returns, but my experience has been very different. So why should I continue? I might as well do a stop loss and get into something else. Maybe it was the wrong choice. What is actually happening is these asset classes or market caps are behaving the way they are supposed to behave, which is have strong years of growth and then couple of years of volatility, and again the cycle turns around. When you are in a single market cap, you are bound to get impacted by such volatility. If you were in a blended product like a large and mid, what happens is you are getting the volatility times. The large cap is helping you stabilize your portfolio. And when markets are on the upside in mid caps, you have a strong participation through such products. So it is trying to balance out your experience on both sides. When markets are up, you are getting a good participation on the upside. When markets are down, the large caps are stabilizing your portfolio, and your and the negative returns or those volatility impact on your investments is not as much. So therefore, there is a very strong case to invest in such products which are giving you stability and also giving you the chance to participate on the upside also.
Okay, interesting. How does this fund, manage sector diversification while still focusing on, high growth and high quality stocks?
Sure. So what typically happens in a large and mid cap category is, as I said, you are investing into the top 250 companies by size in Indian equity markets. On the stock markets, there are roughly about 22 sectors. A large and mid allows you to participate in 20 out of those 22 sectors. So you are well diversified when it comes to investments. Within that, in the scheme specifically, fund managers would make a choice on their active management that which are the right sectors or stocks to invest in. And usually, in our case, we would look at a bottoms up approach, which is other than rather than just looking at sectors, we also look at importantly is look at each story within each business we are trying to buy, and rather than not be only sector driven. So sectors give you that spread. It gives you an idea which are the sectors you should look at, which you may avoid. But within each sector there are good stories and there are not so good stories at any point of time. The idea is to identify businesses which are consistent, viable, to invest in at the time of creating the portfolio.
Okay. Could you also walk us through your investment philosophy, right? Any model that you follow and how does it drive stock selection? Whatever you follow.
So we have a filtering process. Usually at any fund house, and especially in our case, we are covering close to about 480 stocks through primary research or through secondary research, as we are well covered by all research institutions and we take that support. But the fund management team, along with the research analyst team, we filter out through these stocks and we use various parameters, which is loosely, and as you said, is talked about as a model. We look at couple of parameters like what is the scale of the business we are entering in, which means that what sort of runway to growth do they have in the next medium term, short term, and long term. We look at some parameters like what is the return on equity. Why do we look at it? Because that gives us an idea that what has been the return which the owner of the business has been getting out of it. We look at some other slightly heavy data points like return on capital employed, which means for every money or capital being given to the business, what is it able to generate as a business before, say, other taxes, depreciation, or other things come in. We then look at it for other things like what is the type of debt is the business running. Sometimes we also have, then we put on some other filters like, is it a good business but the sector is going through a downturn, or is the sector is doing well but this company is not doing so well? Why does this happen? Then along with these things, we also try to meet the companies, meet their suppliers, meet their competition, meet their other ecosystem in terms of their suppliers, their vendors, and so on, to make an assessment of how is the business being run, other than the metrics or the data which is publicly available. By doing this, all of these efforts, we are we are able to zero down, say, about from 400 plus to about 150 to 200 stocks, and from there we are able to create a portfolio which we think is the best suited for the investor from a medium to long term basis.
Okay. And what role does, current FPI inflow data and macro tailwinds play in this fund's strategy?
Okay. So these are very heavy words, but the FPI flows at any point of time indicates that whether there is a relative attraction from all parts of the world to Indian equity markets. We live in a world where capital is very easily flowing from one country to the other. If it is coming into India, clearly it means that on some data points, we must be surely looking better than others for money to come into India, which that data and that long term trend continues to be intact in India. That as long as our valuations or business models are intact, our growth lines as being given by RBI to be for financial year 26 to be closer to 6.5% estimated and so on, then capital flows continue to be in India. The macro tailwinds, which is a basically it's a very heavy word, but basically what we are saying is the economy looks like to be in a better shape. If you look at some of the data points, services sector last has grown at almost 60 plus. You look at the retail inflation numbers which came in last evening is at 2%. Your WPI, which is your wholesale inflation, is now looking much lesser than what it was earlier. All of this, and your monsoon overall is looking good. So all of this looks like to be in the right position in terms of if the domestic growth engines are intact, that is also what attracts capital flows either from outside India or domestically. Also, people will find it merit to investing into stock markets, but from a medium to long term basis, because short term things could be volatile, but in long term, the earnings actually are in line with the economic and business growths.
Okay. Okay. So these are all the questions that I had. Would you like to, add anything else, any final thoughts or?
So the one of the things which I would like to say is that I just talked about at the start that this is a product which tries to invest into the top 250 companies.
Yeah.
Let me give you some perspective on that. Today, the 250th company, which is technically the smallest mid cap, roughly is around at 31,000 crores. It is actually 30,700 something, but just for conversation, let's take it. It is at 31,000 crores of market cap. That is the 250th company, which is the smallest mid cap. The number one company, as I said, is almost close to 18 lakh crores. So what you are trying to do is invest into a product which is where the smallest company available is 30,000 crores, the largest company is at 18 lakh crores. This is a journey very simply of almost 60 times. So if the companies are able to grow to this manner, our idea is to create a portfolio which tries to capture these sort of stories and growth and stay along and stay invested. So the fund manager will continue to be active and look at those businesses which can grow, which have a higher pace of growth, some which will bring in some safety, some stability to the portfolio. But if the investor were to stay invested for say 5, 7, 10 years, they'll get the very strong, consistent experience, which is a blend of both worlds. In fact, this product, compared to large and mid, or even other some of the other important indices, it never comes first, it never comes last, and it is always the steady middle path, which is sometimes very good for investors. So that's the final thought I'll leave with your viewers.
Okay. Could you also just summarize the NFO for our audience watching? It would
So
be
we
great.
have just started the NFO from the 4th of July, and we are closing the NFO on 18th. The fund will, so we, that's the idea of behind to launch this product. This is a product which we have been very excited about for quite a long time and wanted to launch. But currently now we found that current market scenario makes it a compelling product to launch and start the NAV track record. So I really request you and all your viewers to give it a hard look and makes to be a compelling investment story as long as you are staying invested for a considerable long period of time.
Okay. Thank you so much.
Thank
So,
you.
we come to the end of the webinar. Thank you so much, sir, for sharing your time, insights, and a lot of experience with us. Your perspective on the evolving, fund landscape, product strategies, and investors' needs was highly valuable. And to our audience, thank you so much for tuning in and making this session a success. We hope you're walking away with a deeper understanding and fresh ideas for your investment, journey. We look forward to seeing you all in our next webinar too. Until then, take care and happy investing.
Thank you so much. Thank you.
Thank you.
So